Hey everyone, welcome to the Real Estate Investing War Room Live. I'm Ryan Tennell with Top Producer Investment Capital, and today I'm talking with Gabriel Petty with the Institutional Capitalist. And I would love to just learn more about everything that you've got going on. I think you have a unique perspective with where you are on finding deals in the marketplace and helping other people who want to invest in real estate but are a little unsure on how to get into the business or how to properly evaluate what's a good deal, what's a bad deal. And your background, you didn't start in real estate. You started in the medical industry with a full-time job, and you've kind of made this transition. So I think you really resonate with a lot of people who have full-time jobs right now and are looking to get into that. So welcome to the podcast, and
Thank you.
tell us more about your story.
Yeah, thank you. Thank you for having me. It's a pleasure. There's really not that much difference between medicine and investing. You still have to ask questions, and you have to be detailed oriented about what you're going with, and you have to get all the answers before you can make a diagnosis. It's the same thing with investing. You have to really keep an eye on the big picture, ask the right questions of the sponsors, have a clear definition of what you're looking for in the investment before you can proceed with it. And so the transition was relatively easy from a mental perspective for me, but it's different in other ways.
Excellent. So how long have you been doing just kind of the medical industry? And then
Yeah.
what's the timeline until when you started getting the real estate sector, or just all
Yeah,
businesses? Yeah.
they almost started concurrently. So I started as a PA in orthopedics in 2009 here in Austin. And I had the privilege of working with Tom Burns, who's an orthopedic surgeon here, also an investor. And with his expert history from investing for 40 years prior to this, I was able to capitalize on his knowledge and experience and just invest alongside with him. Starting at the same time, I've been able to get to where I am now and retire from medicine and just live exclusively off of my passive income, which is self-sustaining now because of the investments.
Absolutely. And so tell us a little about like the intentional capitalist that you started here. What's the
Yeah,
thought behind why start something like that instead of just do your own real estate investing?
great question. I started it mostly because I was trying to find something that would help people where I was when I got started. Someplace where I could look for deals, someplace that would vet the sponsors, that I could look at a deal and confidently know I'm not going to lose all my money in this opportunity. And so I did not have any investment knowledge going into it beforehand. And so I really leveraged other people's experience and expertise when it came to that. And so that's kind of what I'm bringing with Intentional Capitalist. We look at deals across many sectors. I like to say I'm investment agnostic. I like to look at different things because different deals offer different advantages to people. And not everything is a one size fits all, as you know. So, I try to get a nice smattering of everything across different sectors that's going to provide some sort of benefit for somebody. And we've got contacts that help us with vetting of the sponsors. I've got a due diligence company I would like to work with. They like to dig up some really good dirt on folks, just experts in the field that can help me feel more confident about moving forward. And since I'm using them to invest in the deals myself, I'm just sharing all that information with other people that are also looking for deals. So it's kind of a win-win for all of us.
Yeah, absolutely. And I know we talk about real estate here, but you look at, like you said, all kinds of deals. So what are some examples outside of real estate of other kind of businesses you've looked at?
Yeah. Well, I'll be honest with you. Multifamily real estate is the majority of my portfolio. That's what has helped get me to where I am. But I do like oil and gas. Some venture capital funds are really pretty interesting. But really other sectors of real estate, whether it's commercial, industrial, self-storage, or even ATMs or car washes, any real asset that's going to have a value to it, I'm interested, especially if it's going to cash flow or have some sort of equity multiple.
Definitely. Yeah. And out of all the times that you've done these deals, I'm curious, do you have any statistics on how many deals you've done and any success stories or any winners that you want to talk about?
Yeah. Man, you have all the good questions. So since I started, I've gotten into 44 investments. I'm still active in 16 of them. And of my 28 exits, 26 were positive. All right.
Mhm.
One of them was flat. I didn't lose money, but I didn't get anything else out of it. And one, I lost everything. All right. So
Mhm.
out of all of the deals, one has been terrible. One has been not so great, but everything else has just been fantastic. And the one thing that I like to tell people is that was a great learning experience. Even though I lost my investment, it was still a great learning experience. It brought me to a sector I wasn't familiar with, and oil and gas can have a huge upside when everything is popping off. And you could also lose everything. That's the big risk with it. But one of the great advantages that I like about it is the tax efficiency. It's really phenomenal. You can write off your entire investment against your adjusted gross income, and the distributions that you get from royalties are also discounted, which is great. So, there's when things are working with it, things work great. When things aren't working with it, it's not. But give and take.
Yeah, absolutely. So I'd imagine, like you said, you've learned a lot going through the process of evaluating all of these deals. Do you have any takeaways from like what was important to you when you first started looking at these deals,
Right.
and then how has that changed over time to the way that you think about investing now?
Yeah, exactly. So when I was first starting out, my goal mostly was to replace my income uh, in the medical world, and so that was my primary goal, was looking at just replacing that cash flow. But then when I saw when I could combine cash flow with equity multiple at the end, that was kind of like the best of both worlds, and so that's what really opened my eyes to the variety of different investments that are available. And so that's when I really branched out. I've had some very interesting experiences when it comes to investing. My first lesson that I learned was really from my dad. I grew up in Houston, and my dad was an engineer before he retired, and a lot of his bonuses were in Houston energy stocks. And you may recall in the early 2000s, Enron and Dynegy were two of the big companies in Houston. And Enron stock went from $90 to a quarter, and Dynegy went from $50 to $8. And
Mm.
so I saw my dad's portfolio. Fortunately, that wasn't his only investments, but it had dropped significantly, and so that really opened my eyes to like the real value of a paper asset versus a real asset. And that, and in combination with reading Rich Dad Poor Dad, as I'm sure most of the world has,
Hmm.
we really want to invest in assets that are going to generate some sort of income for us. I don't know if that answered your question, but that's what kind of triggered when you were asking.
Yeah. So for anyone's tuning in live, we do this live because anybody is welcome to ask Gabe questions about what he's doing and participate in the conversation. But I've got quite a few more. So I guess if you're looking at, you said mostly you're doing, real estate
Mhm.
as well as oil and gas. So if we're, obviously we like real estate here
Yeah.
on this podcast. So when you're looking at a deal, let's say it's a multifamily deal, tell me what goes through your head when you're deciding, hey, is this going to be a good deal? Is it worth even kind of going into step 2, step 3, step 4? What's everything you consider?
Got it, man. So it's multi phases. So like the first step, we're looking at certain key metrics, cash on cash, internal rate of return, cap rates, ROIs, all the things that people kind of look for. And it's not, again, it's not a one size fits all, because sometimes there's different advantages to certain things. But once it kind of passes that initial test, we start looking at the sponsors. And you've heard me say this before. You don't do a good deal with a bad sponsor, just
Mm.
because, I mean, even a mediocre deal can turn to gold with a great sponsor. So it really depends on who's putting the deal together, the experience that they have, if they've done this before, how they've weathered mistakes, and really how they've managed different things. I specifically look for a sponsor that has done this for more than 5 years with the type of deal that they're offering. and they have a good track record of success, transparent financials, which is important to me. I like to review the numbers and make sure that things are going to pencil out the way that they're supposed to. But also, if they've had speed bumps along the way, I want to know how they've managed those, and how they communicate with their investors. Once they pass that level, I like to give them a call, and I like to talk to the sponsors. If they're not going to talk to me before I invest, I'm not interested, because once
Oh
I give
yeah.
them once I give them my money, there's probably no chance that I'm going to talk to somebody. But again, I just want to impress upon your group that, I mean, sponsors should want to answer those questions. They should want to be open with you, because that's their job. They have to. And if they don't know the answer, but I've gotten that one before, where somebody just didn't know the answer to my question, they'll get back to me and they email me the next day, or they'll call, or they really want to give you the information. Don't be afraid to ask questions. I know I'm not the smartest guy in the room, and so I ask a ton of questions. And sometimes, I feel stupid for asking them, but I mean, I know that there's somebody else that's thinking the same question. So I'm going to put it out there and see what it gets me. But once I get past that stage and they've gone through all that, then I start digging into the background checks. I want to make sure that they don't have a criminal history or any bankruptcies or any civil litigations or any other problems, even social media stuff. The group that does the background checks for me, they jokingly say they'll find out if you got caught smoking under the bleachers in high school.
Yeah, that's good.
Yeah, I like that degree of detail, just because I don't want to get into the deal a couple of years down the line and figure out, oh, so-and-so was, he had this lawsuit from the past, and, that's not good, that they're going to stop distributions, or, yeah, this deal just isn't going to make it now, or, for whatever reason. I want to make sure everything looks as pristine as possible before I put my money into it, and before I put my reputation of suggesting to other investors, hey, this is a safe play too. So yeah, I want to be careful with that.
Absolutely. Yeah. It's like you said, it's a couple dollars to just do that check, have the little peace of mind, and have confidence that you're getting into something that's going to be multi-year. Somebody else is in charge of your money, your reputation on the line. So yeah, it makes a big difference.
Absolutely. And once you kind of get it going, then you don't have to worry about it, except for, I like to see the quarterly financials of the project and make sure that it's still performing the way it's supposed to. I'm a little meticulous when it comes to my spreadsheet of stuff. I like to watch it. I'm not watching it every day, but I do like to keep track of it and make sure things are working the way that they're supposed to.
Yeah. So obviously you've done 44 investments, like you said, in these deals, but you have looked through a ton. How many deals do you typically go through before you make an investment, and how many do you think you've analyzed so far?
So it varies from day to day, but on average, it's about 3 to 5 a day. And most of them aren't great deals. And so I would say that it's about 1 to 2% of the deals that we see actually warrant consideration. So, over the year, and this past year has kind of been a weird exception, but I would say around 3,000 deals per year we look at, and we only end up sharing 30 to 40, really. There's not that many. But at least I feel confident knowing that the deals that we share, they've kind of passed all of our, initial tests and stuff. So feel comfortable with that. And if I have capital available, I'm in those deals too. So there's that.
Absolutely. And then, so out of all the deals that you've done, obviously you're looking at quite a few. Are there any red flags that you see that are, somebody that doesn't do this all the time would maybe have stumbled upon, or they can learn from your wisdom?
So a lot of that you can see in the financials. If someone is hesitant to communicate with me, that's a big red flag for me personally. You may not be able to tell from the podcast, but I like to talk to people. And so, I want to be able to get some information clearly. And even if it's just a text message or an email, I want to be able to get that information as soon as possible. I'm one of those people that if you text me, I'm texting you back right away. I can't handle the red dots on the screen. It drives me nuts. But that's, I would say, my biggest red flag. If something doesn't add up financially, then that can be a red flag. But people, we're all human. We all make mistakes. If they can come back and tell me, oh yeah, that was a mistake. We did this and whatever. If they can justify the financials, then that makes a difference for me. But those would be the big ones. It really comes down to the numbers to me. If I can get emotion out of it and just focus on it from a strictly like big picture view, then I feel like I'm done a better job.
Yeah, absolutely. No, it makes a lot of sense. So, moving kind of, I'd like to see or talk more about what's going on today.
Yeah.
It's been a very volatile couple of years after, a 10-year bull market and after COVID. And then, I know we're seeing a lot of people that had bridge debt financing a couple of years ago are coming into some distress with balloon payments here this year and next year. And, we're going what we see with the stimulus in the economy. And, I think they had the banks gave some, what was it, like a delay until March of this year on if they were going to allow them to, I'm not sure the details on that one, but like basically the treasuries that they had sold, they were at a loss. They're kind of covered that until March, and we could see some more bank difficulty there. I think, I've seen a lot of consumer personal debt go up as people's income hasn't gone up, but inflation has. So I'm curious with all that stuff that's going on in the economy, what's your take on like, what are people supposed to do nowadays?
Yeah, man, that's a good question. It depends. Yeah, I just saw a report recently. Fannie Mae has been selling off a lot of their re-performing loans. People who have become delinquent but have caught back up. They're selling those and bundling those, and that kind of is a warning sign to me that maybe economically we're looking at something that could be a pretty big hit in the housing market. But multifamily, I think, is pretty resilient. You hear a lot of reports that there's crisis in the multifamily realm. And I think as a sector itself, it's not in crisis, but there are going to be some deals that are going to be in trouble. And it's going to be the ones that either didn't go through strict underwriting. It could be the people that did a seminar over the weekend and wanted to get in real estate and they got into a deal, and it's tough. There's always going to be opportunity. One of the things that I've been seeing a lot come across my desk recently are a lot of preferred equity deals. Being able to rescue a lot of these different groups, being able to buy a rate lock, helping them get into like an already cash flowing property that is doing, or that would continue to do well if they had that rate lock. That gives us a pretty good position on it. We would still get cash flow from it, at least generating from the debt that we put on. So, I think there's a lot of opportunity, and everything is cyclical. All right. So I think that we're right there on the cusp of things taking off again, probably within the next 18 months or so. I think we still have a little bit of downtime to go. I think the rest of this year, honestly, may be a little low from a good deal perspective. So people who are holding onto their dollars, waiting for a good investment, they're doing the right thing. It's tough to exercise that patience when you have the money ready to deploy. I know, I'm there. And so, but if you just be patient, a good deal will come along. I forget who says it, but the deal of the century comes along every day to somebody. And so I forget who came up with that, but it's true. You can really find a good deal almost anywhere. It depends on what type of criteria it is. I always look at those opportunities as for what problem they can solve. They all have a job to do. And for me, it's either generate income or increase my net worth. And if it's not going to solve that problem, I'm not interested yet, but you're just reminding me of all these great expressions. Even a deal that you're not ready to invest in now, you might be ready to invest in it down the line. Somebody said, that's not a deal I'm going to invest in yet, right? So it really just depends on what criteria they're able to move to get you to the point where it would be a good deal to invest in.
Yeah. So I'll tell you a little of what we're seeing, because we buy deals, and we typically buy value add deals, meaning like we are solving a problem when we go in. And there's a few common problems that we solve. Usually there's a lot of vacancy in the property. It's not being managed very well. It might have some repairs that never got done that need to. It might not be advertised very well, or maybe the owner is losing money, or they're just financially distressed somewhere else and they just want to get the equity out of this one quick. And that's what gives them the motivation to sell it at maybe a discount of a price to what a correctly operated property would trade at in the marketplace. And then in that spread, we can come in and fix whatever the problem is and then resell it at whatever the market price is. And, market prices right now are a little lower. So we're thinking, okay, maybe in a few years when the economy comes back, it'll be a better time to sell. But the people that the stories, at least most of the time, that I see of the deals that look good for us to buy, because we usually buy a good story more than we buy a property. So we'll hear stories of people that are not really real estate people. They're full-time doing something else as a W-2 job. They might be out of state. They might have, hired a property management company thinking this was easy. They would take it over. And I mean, to some extent, that is what a management company is supposed to do. But the management company is never going to care about a property as much as you do. And so it really has to be your job, especially on these, 20, 50, 100 unit deals, to really operate it well and move quickly and be better than the competition, which is everywhere around you. So that's what we're seeing, is people who get into these bigger deals thinking that it's going to be easy and you can outsource a lot of the things that are going to make deals profitable. And then when they don't do it well, it creates a lot of problems.
Yeah. Man, and I love what you do with the value add stuff. I mean, the one that you did in San Antonio, that is fantastic. I mean,
I appreciate
it. It's those types of opportunities where, I mean, you can really make a difference. If you acquire a property at a discount, you already have built-in equity, you do all the value add stuff, and then it just increases so much more in value. You're able to increase rent revenue and retain tenants. I mean, and it looks great. I love it.
Yeah.
Fantastic.
So we do a couple of kind of offerings, and I'm curious to see, because obviously, multifamily is one risk factor. And you had talked about the difference between generating cash flow and then growing your net worth over time. And obviously there's tax benefits in there too. So usually we do two offerings, and they change deal by deal, but usually we do a preferred 10% rate of return, where basically it's kind of like they're giving us a loan. It's part of the equity side, but you give us your money, we'll pay you 10% on that, basically paid out quarterly over time, but you're capped. You can't get any more than 10%. And then we usually do an equity play. We usually try to double somebody's money over the course of 5 years, but most of that will come through the final sale price when it eventually sells. So you usually get a much higher return, but it's prolonged, and there's risk of who knows what's going to happen in the market. Maybe it'll be better, maybe it'll be worse. We'll kind of see what happens. So that's kind of the two options that we give. And, I found some investors like one more than the other. So I'm curious, what's your take on the differences between those? When should investors consider one versus the other? And then I have more questions, I guess, on that. But
I love it.
Yeah.
So again, it just depends on where I am on my rotation and what I've had an exit from. I do like to keep a certain level of cash flow coming in, just because I like to live at a certain level.
Yeah.
But I use those equity multiples to roll into my next investment. And so kind of the combination of both. I mean, I would be an investor in both of those if I could. So I could get the benefit of the cash flow and the equity multiple at the end, because that's kind of like the best of both worlds. I've gotten really good at delayed gratification. And so I can park that money and let it sit for 3 to 5 years and then get a big multiple at the end. And that's great. And then again, roll that into the next project. It just snowballs. But again, I do like the cash flow. I mean, going to the mailbox and getting a check, or just looking at your bank account and seeing all the magic money kind of just duplicate itself. That's a pretty good feeling.
Yeah.
So I do like both of those. But again, it has to solve one of those problems. Either it's producing income or it's increasing your net worth through equity. And so what you're doing with the value add, that builds in the equity, and I love it. It forces it, which is good.
I think you had a good point about delayed gratification and taking time for things to mature. I think Alex Hormozy said, like, the man who can wait an entire lifetime before he gets paid will get paid the most. If he can wait that long. So yeah, it's definitely a fine line there. So the other part of the question I was going to ask is, we've got like value add multifamily, at least the deals that I'm seeing, usually get marketed, 14 to maybe 17% internal rate of return over the course of 5 years, maybe 3 or 4. I also see construction deals that are out there. I also see A-class deals that get traded. There's things like laundromats, ATM machines,
Yeah.
all kinds of other stuff. So I'm curious, I'll tell you mine, but I'm curious your perspective on how do you weight the risk of these different types of asset classes compared to, because, you could double your money playing blackjack in a second, but, is it worth it? Right.
That's right. It really comes down to your risk tolerance. And do you like to gamble? And so I'm not a big gambler. I like a pretty. I'm extremely conservative when it comes to my portfolio. But there are times when there's a project that's already kind of set and going, and they've demonstrated success from a previous iteration. Then I'm pretty comfortable going through with it, especially if I've dealt with a sponsor before. There's so many different opportunities to get in at an optimal time. Again, I'll go back to the oil and gas thing, just the last time, I promised. But one of the lessons I learned with that is there's a window of when you can invest in those things. And I like to be on the end of the opening of the window, just because usually at that stage, they've already drilled exploratory wells and have some degree of production before they close that investment window. And so instead of being in at the very beginning where you may get the most benefit from an investment perspective, from a percentage standpoint, I prefer to lose out on a little bit of those gains in order to, I would say, lock in a more secured return down the line. And so that's kind of where I am personally when it comes to it. Again, I'm risk averse.
Yeah.
I absolutely hate losing money. And I feel even worse if somebody else I know has lost money because of something that I've suggested. And so again, I'm extremely conservative when it comes to that stuff. Yeah.
So if we were to put some numbers to all of these, like you go to a high yield savings account, you get 4.5 to 5.5 or so % right now. Where's the kind of level where you're like, well, it makes sense to take it out of that account and move it to something slightly riskier,
Right.
but it's still pretty conservative. How far do we go?
Yeah. So, I mean, I saw a deal recently where they were going to give, I want to say 6% on a project. And I thought, well, I mean, 6% on a risk versus a 4% guarantee, that's not gonna move the needle much for me. I'm looking more at 8% or more before I would consider moving into something that is going to, I have to do some risk management. But I would say 8% is probably my low end before I want to start. I mean, before I would even consider anything. I do like getting more. I mean, we all like getting more.
Of course,
But
yeah.
I think the higher percentages that are promised, that's a higher hurdle for the deal sponsor to provide. And I want to keep the operator incentivized to make the project worthwhile long term, instead of just making those interval hurdles of whatever X percent. So it's difficult to say. It really just does depend on the project. I know that sounds fickle, but I mean, it really just depends. And I have to look holistically at it and see what all I'm giving up for it. But again, bottom line, I would say 8% would probably be my low end threshold of even considering a deal. I do like double digit returns better. I mean, everybody does, but now I think that we're looking into a market where I think 8 is probably going to be the norm, between 8 and 10. And we're going to be holding things for more than 3 years. I mean, we got very lucky the last several years where you could put money in almost anything and it would generate 12, 13, 17% or whatever. And you'd get a 2x multiple after 3 years. It was like magic.
Yeah.
And I admit I was very lucky and got in on a lot of those deals. But now I'm seeing more of 5 to 7. I saw one just yesterday going out to 10 years, a 10-year hold, and they were promising a 16% return, but and then a 2x at the end. And then we're also going to return 60% of the capital at refinance in 4 years. So you weren't totally stuck in there for all 10 years. But 10 years is a long time to wait. I don't know if I have that much delayed gratification, but I think a nice sweet spot for me is around, I would say, the 5-year mark. I think that's where we're going to get the best bang for our buck. That may be where we are economically when we have to hit the next high point. But we all just see. I mean, real estate and office is going to be really strange for a while. After COVID, when everybody was working at home, office vacancy is crazy right now. And so, I mean, it's really interesting. Ken McElroy did a blog recently about conversions of office space to residential. And yeah, it's costly, but that may be a way to go to salvage these good buildings that, they just don't have a use right now. So I don't know.
I'm so curious because I've heard stories where, I haven't looked into much office, but I hear stories where something was built for, $10 million and it lost more than 50% of its value because of the vacancy and what's going on with office. And, it's sometimes that might be like, it might be cheaper than the cost it was to build it. So I have to think like, I mean, maybe it's difficult for office right now, but maybe at some point either it comes back or gets repurposed in a way that, hey, the structure can be good for something.
Yeah.
So I'm curious on office, like anything that comes with a big discount, it's like, well, let's figure out a way to make this work somehow.
Yeah, so I agree. I'm with you on that. And if I had a bigger war chest to go after some of those things, it would be amazing to get a huge discount like that and just hold it. And that's what the institutional players are doing, is they're buying these things at a huge discount because they can wait. They can wait generations for that to turn. And that's fine. And they're also comfortable accepting 4-6% returns on their money and not worrying about it.
Yeah.
But it just depends. They're also dealing with billions with a B. Whereas, you and I may not be.
So we've talked a little about office. I'm curious, what do you think about Airbnbs, short-term rentals, hotels, all that sector?
Yeah, Airbnb is really cool. So there are some interesting strategies with the Airbnb stuff. It's, to be honest, I really don't know. I mean, I've just read a little bit about it. I'm not so big on single family rentals or Airbnbs. I like to do more doors per dollar. So apartment complexes is what I like to do. But I know people who have done really well with just a slew of single family rentals and Airbnbs. I mean, they're just killing it. So there is a way, and there is a really cool strategy where people can get in at the end of the year, get some really cool depreciation out of doing some value add, unloading it, and then just repeating the cycle next end of the year for some benefit. But I mean, that's just not for me.
Yeah. Have you looked into industrial warehouses at all as well?
Yeah. So there's a group in town here in Austin that does look specifically at those things. And they do a really interesting buy lease back thing, especially if the business that's in the building is producing, but they just may be cash poor. So they'll buy the building, lease it back to them, and generate cash flow for investors, and then resell the property down the line. But I like industries that are still probably going to be around. It's difficult to say with the advances of AI and automation and robotics where we all are. I'm not going to buy a Coach Whip factory, with all that. But it's really interesting. I think that you can find really cool opportunities. There was a very specific company. I want to say it was in Wisconsin. They're the only supplier of this one technique for, like, I think it was Polaroid or something. I would invest in that. Because they kind of have the corner market on something. That may be something. It may just be throwing money away, but I mean, everything is a risk. There's nothing that's 100% guaranteed. And if you're looking for opportunity, then you'll find it. You just got to look.
Yeah. So with other people who are looking to get into this, obviously what you do is you help people get into the space, and it kind of seems similar to like a family office where, one wealthy person will have a team of people do all the work for them and just make recommendations on investments. You're kind of running a family office for everybody else, who wants to get in. So if somebody wanted to do this, do you charge a fee? to like look at deals? Do you take a percent? What's the structure?
Yeah, great question. So I don't take any fees from any of the deals that we get into. I do that for a couple of reasons. I don't want to demonstrate that there's any bias involved at all. I just want to make sure that there's no favoritism or anything. If I think a deal is good, then I'm going to invest in it and I'll post it on our portal. But it's a fee for service. It's a membership that people would subscribe to. And what they get for it is not only just the deal flow, although, I mean, that's pretty cool just to have the deal flow. But they've got a section of wealth resources where I've kind of put together all the things that I thought were helpful for me along my investment journey. Also, a list of contacts of experts that I go to for legal work, setting up entities, setting up retirement accounts, using special tax to be proactive about taxes, tax planners, CPAs, like the whole gamut of experts of things that I am not an expert in. I make that available to all of our members. And plus, they always have one-on-one access with me anytime they have a question, concern, whatever. I mean, I'm not the only one finding deals. There are people in different circles that find deals, and they can bring them to me, and we'll go through them together, and I'll give them my opinion. Mm-hmm. It may or may not be a good deal for me or the group or whatever, but if it fits their particular criteria, then we can work with that. But I just want to make sure that they are clear on the numbers. A lot of the people that are using my service already are professionals that either don't have the time or care to do the searching for the deals and the due diligence. They just want to leverage their time and their money to hire somebody else to do it for them. And it's great because I would do it for myself. And so I'm just doing it and sharing it with everyone else. So it's a fee for service.
Yeah. And I mean, can I ask like, what's the fee? And then do they,
really just depends on what all people want. But right now we're setting it at $6,000 a year, which comes down to about $500 a month. But for people who are listening to the podcast, I'm going to give a 20% discount to the first 20 people that reference the podcast. Yeah. And I'm also going to include a free ebook for all the due diligence tips and tricks that I've learned over the last 15 years. It's 56 pages of with checklists and how to do whatever. But it's been all the key things that I've gone to when I'm evaluating a deal. And over half of the due diligence guide is about vetting the sponsors. Mm-hmm. So not just looking at the deals, but the people running the deals is where it makes the biggest bang for the buck. You really got to make sure you're doing your due diligence there.
Yeah. And then do you run like a Facebook chat, Discord? Like where do people interact and see the deals?
I'm not great with social media and I'm working on that. So I have a LinkedIn. I guess people could reach me through that. My cell phone number is on the website. You can also email me. Just go to intentionalcapitalist.com and go through the website. You'll see all the contact sources there. And you can download the ebook and anything you want. Just kind of check it out there. But you can email me, Gabriel at Intentional Capitalist as well, and we can chat. You can also get on my Calendly link through the website, and we can schedule a time just so we're not chasing each other down because I know everybody else is busy too. But yeah, just get on Calendly and find an open spot and we can chat and see if I can help you reach your wealth goals. Yeah.
Absolutely. I know a lot of people would love to be in that position. So that's the kind of questions we need to be asking. And then do you just, when people sign up, do they get emails when you find a good deal or? Yeah. Okay.
Yeah. So we have a portal. It's a secured portal. So you'll get a login for that stuff. It's through an app called Circle. So you can download it to your phone if you want. It's Android and Apple compatible. But you'll get a ding notification when there's a new deal. It also emails you that there's a new deal available. But I'm also sending out newsletters all the time so that people are aware of how well our deals have been performing. So I usually call it the deal dashboard. So they can kind of get a perspective of how well we're doing. I don't know if I answered that, but yeah, the portal is called Circle, and they'll get a secure login. But yeah, they'll be notified right away.
Cool. No, that's awesome. I mean, anything else that's kind of on your mind, or any topics
Yeah.
that we haven't covered so far?
Yeah. I mean, I just want to reiterate, don't be afraid to ask questions of sponsors.
Mm-hmm.
That is their job. You really ask questions. There's no stupid question when it comes to investing, and don't invest in something you don't understand. If you are uncertain about it, it's not the right deal. It should not be complicated to get into a deal. I'll help you with some of the finer points of those things, but I mean, some of the stuff gets really complicated, and it does not have to be. Use your time. Time is the best asset that we have. That's the one thing that we don't get any of it back. So use your time wisely. And if you can leverage another resource to get your time back, I encourage you to do it. My life has changed dramatically being able to get my time back. Instead of slugging away 9 to 5, seeing 60 patients a day, I'm able to really change lives in a different way.
Yeah, no, I absolutely agree. And I think you had a really good point on asking questions of sponsors. Like that, as a sponsor myself, that is my job. I love it when people ask me questions. I got nothing to hide. Some people do, but you'll figure out
Right.
if you should invest with them if they've got something to hide. And with these, we put videos out there. We try to be transparent, and part of my job is seeing what is out there in the market. And so it's kind of similar to what you do. I look at all the other multifamily deals because I'll see something, and we'll see a property and we'll bid on it, and we'll bid 3 million for this property. And then the broker says, oh yeah, sorry, they ended up going with a different offer. And then, I'm on everyone's distributions list too. So 3 weeks later, I'll get an email saying, hey, we got this deal under contract, and I'll watch their seminar. I'm like, well, what'd you guys pay for this thing?
Right.
We didn't win it. I know this is a deal that made sense for us. And they said, oh, we paid 3.3 million, and they did something to the underwriting to say, well, our assumptions may be a little more aggressive. And there are some people out there that might have better operations and might have some efficiencies that we don't have. But a lot of times, if you can get a lower price on something, that's kind of the way to go. So I'll still look at everyone else's deals and we'll see what comes up. And I've also seen a lot of deal decks that look very sexy and have a lot of sizzle to them, and they have good sales pitches. But then, you got to ask, like, let me see your underwriting, and not just, the offering memorandum. You can ask them for, like, well, let me see your Excel document. Because a lot of times people will send like a PDF. But if you get the Excel of how the underwriting is actually done, you can see, well, how was this formula created?
Right.
Granted, maybe this is where your expertise comes in. Because, some of these are like our underwriting template is 7 sheets, and there's a ton of formulas, and it calculates a lot of this stuff for us. But the assumptions going in, and I have other sponsors send me their underwriting, and I'm saying, well, I'll kind of go through all this and see where it is. And you can see how aggressive their assumptions really are, how conservative they really are. And then, like you said, if it's really complicated and you don't understand it or you're not familiar with the space, it's really your job to reach out to the people who are familiar with the space, and they'll give you their real feedback. And they'll say, here's the 5 things that I have a problem with. Here's the 6 things that I think are great. Here's the questions that I would really ask. And then you have all the ammunition to come in and properly evaluate the deal, even if you're not familiar with the space. So, and that's the service that you're doing for everybody right now, and just giving them opportunity to even see that this space exists. So that's so cool.
Well, thanks, man. You nailed it, though. That the prettier the brochure, the more skeptical I am. Almost like an ugly presentation, because it tells me that their talent is maybe not in doing a pitch deck, but really running a property. But yeah,
it's funny too. Like when I get calls from, like, if I get an email from a broker and they say, hey, we've got this deal, I'll send you the offering memorandum, 20-page PDF, beautiful color. I'm like, oh, it's too expensive. It doesn't even matter what the price is. I don't even want to really look at it.
Right.
But like, I'll get a phone call and they'll say, hey, Ryan, I just talked to this owner. For whatever reason, he needs to sell pretty quick. He sent me his financials. They don't look too pretty. Can you look at it? I'm like, oh my gosh, there's a deal in here. So we'll go through. The Excel's missing some stuff. They hand wrote down what their rent roll is. I'm like, this guy's so disorganized. There's no way he's running this property well. There's opportunity here.
There's room for efficiency. I love it.
Like you said, but when you're evaluating sponsors, they need to have professionalism. They need to have their stuff together. Granted, maybe their expertise is in finding deals or operating them more than putting a pitch deck together, but they still have to be organized enough, because you're dealing with other people's money. You got to have everything buttoned up.
You're exactly right, man. It is a sacred responsibility to be in charge of somebody else's money. You've really got to have everything in the row. You got to have it. But I mean, stress testing, you'd mentioned that you really have to have those sensitivity tables going, stress it down, make sure it'll still work when occupancy drops, or, when, God, what am I trying to say? When rent does not appreciate, or all the different things, you really have to stress it and make sure that the deal is going to work no matter what. But
yeah. Every model that I've seen, factors in usually a 3% assumed rent growth. I mean, Austin over the last 12 months was like -1%.
Yeah.
The year before was 20%. So like you kind of go, but like, you kind of say, okay, a sponsor's putting in 4%, 5, 6% in there. What happens if it only gets 2 or stays negative? Like, not that may or may not happen, but it's like, how bad does it get? Like, are we losing money at that point? Are we breaking even? Are we still somewhat profitable? So,
yeah, those are great questions, man. You got to exactly. And I always like to know that the sponsor's putting their own money in the deal too. That's a big key for me.
Yeah, super important.
Cool.
All right. Well, appreciate your time coming on. I know you mentioned earlier where people can get a hold of you. If you want to just reiterate that one more time, best way to get a hold of you.
Yeah, absolutely. So if you just go to the website, intentionalcapitalist.com, you can go through the website and find me there. Or you can email me directly, gabriel@intentionalcapitalist.com. And my cell phone number's on the website. Drop me a line. We'll get together and we'll figure out what's going on, especially if you're local.
All right. Awesome. Well, thanks for everybody watching and tuning in, and make sure to reach out to Gabriel. He'll take good care of you guys, and happy investing.
Thanks.